What's good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades, home of your trading BFF and your stock market bestie. In my opinion, the stock market is too high, flat out, too extended. Most stocks are just too expensive right now. That's my opinion. And there's a lot of people who agree with me out there. A lot of smart investors agree with me. And there's just too many outside factors that are telling me that the market is too extended right now. Record high unemployment, cases on the rise, an election. We're gonna probably have a regime change in the White House. There's just a lot of outside negative factors right now. And don't even forget that we're trading up near all-time highs, and those two things don't go together. So what do you do when the market is too expensive? There's not a lot of good value stocks out there. The growth stocks are expensive too. What do? Do you sell out of all your positions, dump all your positions, and make your portfolio 100% cash? No way, Jose. You do not do that, because you need your money out there working for you like a bunch of little soldiers going to battle every single day to grow your portfolio, to grow your investment account. You want that money in the stock market at all times. And I use a couple strategies when I think the market's too high to not only protect myself, but maximize returns and maximize profits. And that's what we're gonna be going over today. I'm gonna show you my favorite strategies when we're trading and investing in an extended, expensive stock market that I use to protect my portfolio, to protect my account, and to make money no matter how expensive the market is. So if you're new to the channel, consider subscribing. And before we get started, make sure you get your two fingers, dust them off, and snake eye jab the like button for me. And you jab it and you twist it. And then when it turns blue, you know that like button has gone blind and you've done your job. All right, let's break down these strategies. And as always, let's secure that bag by making smart investments and sound trades. Let's get it. All right, guys, let's talk about my two favorite strategies to use in an extended market. I don't use these strategies when stocks are cheap. If the market's down off the highs 30%, then you don't need to ever use these strategies, because there's a lot of good deals out there. You can buy value stocks at a good price and just ride the rebound higher. All right, so I only use these strategies when I think the market is about to pull back, and I think the market is about to pull back. Why? Record high unemployment rates. Rona cases. Yeah, we just had good news about a vaccine, but the Rona is still a huge underlying factor. Okay, the election, we're probably going to have a changing of the guard in the White House with a new administration coming in, being more restrictive towards big business, towards big corporations, and big corporations paying taxes. That is not good for the stock market. Okay, and finally, we're just too high in my opinion. We've been grinding higher for the last almost 7-8 months. And I think it's time for a little bit of a correction. All right, guys, before we get started, let's talk about Webull. Webull is my top broker right now. Out of all the brokers out there, my favorite one is Webull, and they are offering an excellent deal. If you're looking for a new broker, check out the link in the description for Webull, where you're gonna get not one, not two, but 3 free stocks valued up to $1,600. So with the market trading at all-time highs, you can make a guaranteed profit. If you open an account with Webull, deposit $100 or more, you'll get 3 free stocks valued up to $1,600. That's a deal you can't beat. Check it out after the video. All right, guys, so the first strategy is the most straightforward strategy, and that is short selling stocks. Short selling is a risky strategy. You got to know what you're doing if you're going to be using this strategy. Don't just start short selling stocks because you think the market's extended. That's going to get you in a lot of hot water. Short selling is when you basically are betting on a stock to go down. So let's say you sell at 350, you short sell at 350. What you're doing is you're borrowing shares of whatever stock you're selling. So let's say it's stock ticker XYZ. The ticker symbol is XYZ. It's trading at 350. You think it's going to go down. So what you could do is borrow 100 shares from your broker I'm just using 100 shares as an example. You sell at 350, you short sell at 350, and then let's say it drops to 320 or 330. Let's say it drops to 330. So you just made $20 a share. You buy it back at a lower price, and that's closing out your position. So it's basically just the opposite of in buying a stock. Short selling is the exact opposite. But it's more risky because when you buy a stock, the most you can lose is 100%. But when you short sell a stock, your risk is literally infinite because stocks can keep going up, right? But they can only drop to zero. But they can go up 500%, 600%. That's why I don't recommend short selling as a strategy to new investors, to new traders. You got to practice. Use paper money, practice this strategy, and I'll show you how I short sell personally. For example, we're looking at the S&P 500 chart right now, right? And I think the overall market's extended. So what I could do is take a position, right? So what I like to do is I like to sell into strength always. Doesn't matter if you're buying, doesn't matter if you're selling. Sell into strength and buy into weakness. Short selling is no different. So I like to sell the rip and then buy back down when it's dropping. So in this situation, I would wait for the next pop, maybe in a 360, and I would have a plan. You always have to have a plan when you're short selling. So maybe I open my first position at 360, I take a starter, and then I have plans to take another half of the position at 370. You never want to fire your whole load in one wad. Remember that. That's a good life lesson. Don't blow your load the first time. Always keep some ammo on the sidelines. Never take your full position the first time you enter the stock. Doesn't matter if you're buying or short selling. So we would take our starter at 360. We would take our second starter at 370, which would give us 100% of our desired position. You could use 3 different orders or 3 different levels that you want to add at, but make sure you have a plan before you start short selling a stock. Then we would set our stop loss, let's say at 380, and then we would set our profit target down here at 340. And then you have to respect the plan. If it just keeps going higher, take the loss. Because like I said, especially if you're using margin, you have to have a margin account in order to short sell stocks. Brokers require it. So if you're using margin, which you probably will be if you're short selling because you have to, then respect your stop. Number 1 rule, respect your stop. Go into the trade or investment with a plan. Okay? This is the most important aspect of short selling. Always sell into strength. Never short sell, try to find the breakdown point. That's a bad idea. Always sell strength, buy weakness, and you'll make money in this game. And follow the plan. If you think it's going to drop to 340, set your first buy zone at 340. Maybe take 75% of your position off, and then buy the rest out back at 330. That's strategy number 1. That is short selling. Try it out. Use some paper money, a paper trading account, and try it out. Right now is a good time, in my opinion, to get short a lot of these companies that have made huge moves over the last 8-9 months. All right, let's talk about my second and my favorite strategy for a market that is too high, and that is called selling covered calls, right? So let's say, for example, Hyliion. I wanted to invest in Hyliion as it was dropping. It's been dropping for a minute, and I wanted to buy the dip, okay? But I was scared that it was going to continue to drop. So what I did is I took a starter position at $25 per share, and then I sold a covered call. What that is doing is you're selling a call option. Let's go take a look at the options chain. So what I did is I sold the November option, and I sold the $25 contract for $1.40. And what that does is it protects you from downside risk. It lowers your cost average. Let's go back to the chart. It lowers your cost basis. So I bought it for $25. I was scared it was going to continue to drop, but I wanted to get some exposure. So I bought 100 shares, and then I sold one November $25 strike call option for $1.40. What that did is it lowered my cost basis from $25 to $23.60. What happens is if at expiration, at November expiration, if it's trading over $25 per share, your 100 shares that you bought will get took away from you, and you keep the $1.40 credit that you gained from selling the covered call. Let's say it keeps dropping like it has been and continues to drop, and at November expiration it's trading at $17 a share. You still keep the $1.40, you keep your 100 shares, and then you can do it all over again. And what I like to do is to buy stocks that are dropping that I think are oversold, and then sell covered calls on them, and just every month sell one contract, and keep doing that. And eventually you're going to lose your 100 shares, but because you've sold 5-6 months worth of covered calls, it doesn't matter if it keeps dropping. You're still making a nice credit on those options contracts that you're selling. So what I like to do is I always like to sell the strike price near where I own the stock, because that's just a good area to sell the strike price, and it lowers your average cost. It's a very efficient strategy, very low risk strategy, because you can continue to sell the options contracts, especially with a volatile stock like Hyliion that's been dropping the past several months. Then those options contracts are going to be more expensive, allowing you to gain more of a credit, more profit when you sell them. So I've done this 2 months in a row, and it's worked out beautifully. It looks like I may get at November expiration, we may be trading over $25. If that happens, I will lose my 300, 400, 500 shares that I've been doing this on since back here, but that's okay, as I've made a lot of money from selling the contracts over the last couple months. I'm still long-term Hyliion, but that's a different topic for a different video. But this is a good strategy to use on any stock that you believe is oversold, or you still want to invest in a stock that's too expensive in your opinion. If you want to buy, for example, if you wanted to buy Hyliion after it made a 100% move higher, you still thought it was a good deal, you can use covered calls to lower your cost basis. And right now we're trading in a market where a lot of companies are good companies, right? They're still good investments long term, but they're very expensive. So one way to lower that average cost is to sell covered calls. There's a lot of good material online about selling covered calls. What I talked about is just the very basics. So go on to Investopedia.com and check out covered calls, or just Google what is a covered call, and that'll give you some more in-depth details. But it is a good strategy to use when a stock's either oversold or it's extended, and it'll help you to lower that cost average down. All right, guys, that is my 2 favorite strategies to use when stocks are just flat out too expensive. Hope you guys enjoyed the video. If you did, remember to subscribe and hit that notification bell. Also, hit the like button for me. It tells YouTube that these videos carry value. And check out the link in the description for Webull. If you're looking for the best broker out there, Webull has a great deal. Deposit $100 with my link, and you'll get 3 free stocks valued up to $1,600. Check them out. Until next time, you know what time it is. It's time to say peace out. Until next time, peace.